Good morning, everyone, and thank you for joining us on Morning Markets today. Before running into the market and what's happened over the past 24 hours, I just wanted to mention that tomorrow we'll do a special on the UK budget, so look out for that tomorrow afternoon. So no morning markets in the morning, but a special afternoon slot tomorrow. So then just looking at asset markets yesterday, I think looking at a bit of stability in sovereign bond yields following that move that we discussed in terms of the move out in yields over the course of last week. That played through, providing some support for equity markets. And we saw strong performances really from equity markets yesterday, taking back most of that weakness that they'd shown last week. So for example, the FTSE here in the UK was up about 1.6%. S&P and Nasdaq in the US materially stronger than that, up 2.4 and 3% over the course of the day, and indeed both of those indices closing close to their highs on the day. And I suppose just drilling into it a bit, it's also worth just noting that it was strength across equity sectors. So we saw the technology area of the market doing well alongside the more economically sensitive areas of the market. Just putting some context in that, just in terms of the improvement in yields that we did see yesterday. If we look at the 10-year in the US, it ended the day at about 1.42, coming in 3 basis points over the day. Looking here, closer to home, in the UK, 10-year gilt closed at about 75 basis points, coming in about 8 over the course of the day. So that, if you will, stability in the market really did provide a bit of positive sentiment for equity markets, and just that stability rather than that speed and rate of change that we've been seeing last week. I think it is just, however, worth noting that whilst we did see that stability around the middle of the curve, so that sort of 7 to 10 year level, as we go out into the longer end of the curve, we did see sovereign bond markets continuing to see yields move up ever so slightly there. Not at the same pace as we were seeing last week, but yes, they did creep up a little bit. I think the thing there that's also keeping in mind as to what's happening at an economic level, and yesterday provided us some further evidence of the positive dynamics in the US in particular, and we saw the ISM manufacturing PMI number come in at 60.8 from 58.7 last month. That's quite a big improvement. I don't think many forecasters were expecting that. So again, speaking to that ongoing improvement in the US. Looking at other regions, we had the Eurozone final PMI reading coming through for February, coming in at 57.9, marginally ahead of where it had thought it was going to come in. And then this morning, we saw a pretty strong manufacturing reading from South Korea, with the PMI there increasing to 55.3 from around 53 previously. South Korea is an important economy from a global manufacturing perspective. We think about technology, we think about autos, etc. Very important parts of the Korean economy tied into global trade, and that is certainly boosting sentiment there. I think just the other thing, when we dig into all of the PMIs and we look at the underlying components of that, yes, we're talking about positive from a supportive backdrop in terms of the manufacturing side. With digging within that, however, you do see a bit of supply chain challenges, so lead times increasing, and also we do see the impact of rising raw materials feeding through in terms of the input costs that manufacturing businesses are experiencing. And that all is tying back into this narrative and exploration within markets today about inflation and economic growth, improvement in activity levels. How does that feed into inflation, particularly as we go through this year, because of that transitory effect of lower inflation last year because of the impact of COVID-19. And that's really what's driving sovereign bond yields. It's driving the discussions in markets at this point in time. And really, those discussions, we touched on it yesterday, the importance of central banks and how central banks communicate at this point in time. We saw the RBA over the course of last week take action. They had their monetary policy meeting overnight. We heard that there's no change to policy as expected, and they will continue to target that 10 basis points yield on the 3 year. They also were at pains to point out that they do have more quantitative easing planned, and it has already been planned. So that is again there to help them should the market try and force that 3-year yield away from the 10 basis points level. We also, from the ECB yesterday, we heard from the Bank of France governor discussing just the speed of move that we saw in sovereign bond yields, and basically suggesting that the ECB must and should react if that rise at all impinges on financial conditions. So expect more of that rhetoric maybe over the coming days, and I think we hear from Fed Chair Powell as well later in the week. So it'll be interesting to get his take on what we saw last week as well. Just then, really, in Asia overnight, we've touched on what we've heard from the RBA. Just looking at another regulator speaking, we had the Chinese banking regulator discussing, and that seems to have knocked a bit of confidence in Asian markets. Just discussing overall asset market levels, also thinking about maybe regulation as it relates to the housing market within China. That does appear to have knocked a little bit of sentiment overnight. So Asian markets a little bit weaker as we look at them this morning. On the economic front as well this morning, it's just worth noting two data points. One, here in the UK, we've the nationwide house price survey, which continues to point to the positive momentum in the housing market, with prices increasing 6.9% year on year. Do remember that is tied to the stamp duty holiday, which has been beneficial. We have the budget tomorrow. Be interesting to see if there's any movement or change to extend that scheme over and beyond its expiry. And then also just this morning, a really interesting set of data points from Germany. So remember, we've discussed the manufacturing side in Germany, the strength there. The services side has been weak. Looking at retail sales for January, coming on the back of a pretty disappointing December number, retail sales for January have come in dropping 8.7% year on year, or about 4.5% month on month. So really the impact of that second lockdown in Germany is very much impacting retail activity. So just really again emphasising why the strength in manufacturing has been so important. I'll leave it there for today, but as I said at the beginning, we've got the UK budget tomorrow, so please do look out for some commentary tomorrow afternoon on the budget. Thanks for joining us, and I'll look forward to seeing you again tomorrow.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.